Today we will be presenting about the best practices on conducting financial audit. Joining with me will be Bhakti, Jyoti, and Judith. So to begin with, we will introduce you with the audit process, and then we will have quality control, peer review, sampling, and other topics, so on and so forth. Why do we need audit? Most of the time we will think like audit is not mandatory here in the United States, but still client get audited, except for the public companies. So, audit report gives credibility to the financial statement, which is prepared as per US GAAP or IFRS. And audit is an objective analysis and examination of some sort of company's operations to confirm the extent to which organization is in compliance with expected standards. Audit can be for different purpose. Like for financial audit, company look at the financial record to make sure they are correct. In case of compliance audit, it is designed to ensure that company is complying with the applicable regulation or laws. And the process for specific audit will depend on what type of audit it is being performed, as well as what set of standards govern the auditor's work. It can be US GAAP, IFRS, IGAP, etc. So, moving on, when we start with the audit, it starts initially with an engagement acceptance letter. Before that, we issue some kind of notification to the company or the organization that is being audited. A letter is generally sent which will specify the purpose of the audit, when it is being conducted, the date, time of initial meeting the auditor would like to schedule with the company leaders. Audit, we should maintain ethics and independence as an auditor. And then we have terms of the engagement. So this terms of the engagement is laid down in engagement letter. It should be accepted by the client. So what are the components of engagement letter? As we see, apart from audit, we send engagement letter to the client as when we initiate an engagement. So engagement letter with respect to audit consists of objectives of the audit, responsibility of the auditors, responsibility of management, the framework which we are using for auditing, expectations from the management to provide management representation letter, of course, our fees and the billing. Engagement letter forms part of our audit documentation as well. Moving forward, we assess the risk and plan the response. Once we get the engagement letter, every audit should start with an audit planning. So we will have a planning meeting among the team members. We will have knowledge of the client business. We should understand what is the client accounting being used because it will affect the design on the internal control. We should inquire client personnel about recent changes or the developments. We should review previous auditors' report. We can review tax return, SEC filing, and if possible, tour around the client facilities. We develop audit strategy. So what do we mean by audit strategy? We do preliminary evaluation of materiality, audit risk, internal control, material location, account balance, size, complexity. Then we set up materiality for audit. So what is materiality? It is a qualitative or a quantitative judgment. That is a percentage of appropriate financial statement benchmark. The financial statement items on which user focus their attention when evaluating financial position or performance. It may be based on revenue, gross profit, profit before tax from continuing operations, net assets. Materiality is performance materiality and tolerable misstatement. Performance materiality means auditor determine performance materiality for the purpose of assessing the risk of material misstatement and determining nature, timing, extent of other audit procedures. By tolerable misstatement, we mean maximum error in the population that auditor is willing to accept. Then we move to risk assessment procedures. It is required in all financial statement audit. It enables the auditor to identify and assess risk, respond to risk, areas that require special audit consideration. And then, based on that, we design further audit procedures. Then we understand entity and environment in which our audit, like we being an auditor, is auditing the company. We understand internal control. We identify and assess the risk. Risk can be of two kinds. financial statement risk, and assertion level risk. So, what is financial statement level risk? It is the process which is used to prepare financial statement, develop estimates, selection of accounting policies, and overall control environment. So, what is assertion level risk? It relates to specific transaction, account balance, or disclosures. Based on our assessment of risk, we respond to risk by performing the procedures and obtaining of evidence. So, as per our next slide, we perform audit procedures. Audit procedures can be test of control or substantive testing. Substantive testing is further broken down to test of details or analytical review. What is test of control? So, for test of control, we evaluate operating effectiveness of internal control. Substantive testing, with respect to test of detail, involve detection of material misstatement, where we try to test account balances, transactions, and disclosures. When it comes to analytical review part of substantive testing, we try to identify unusual transactions and events by performing analytical review, or we identify transaction and events that have occurred since the last audit period. Then we perform conclusions. In order to form conclusion, we should test subsequent events. Subsequent events testing is done to identify contingencies and unrecorded liabilities. The purpose is to identify unrecorded liabilities. Other ways where we identify contingencies and unrecorded liabilities are by reviewing post-balance sheet cut-off transactions, management representation letter where management should disclose to us that they have identified and informed us of the subsequent events. And we can review the minutes of the meeting to identify the subsequent minutes cover any post-acquisition, mergers, etc. We can also review the interim financial statement. Then we obtain management representation letter after we conclude all our field work related to audit. So generally, auditor prepare the text for management representation letter and it is printed on the client letterhead and is signed by the client. It should cover up to the date of auditor's report and it is mandatory if we are going to issue an unmodified opinion. We evaluate audit results based on our subsequent event testing, test of control, and substantive testing. And then we report on the financial statements. So for reporting, there are other reporting considerations, and reporting on financial statement involves 4 kinds of opinion. If we are issuing a clean audit report, we will issue unmodified or unqualified opinion. We also issue adverse opinion. We can issue disclaimer of opinion similarly. So what is the difference between adverse opinion and disclaimer of opinion? Adverse opinion relates to accounting policy issues. Disclaimer opinion relates to accounting standard issues, like if we were not allowed to audit a particular inventory item, which is a major component of the financial statement. Then we issue disclaimer of opinion because we were not able to perform the audit procedure and we cannot issue the opinion, which is material. And there are other reporting considerations. So generally, this considerations covered mostly for the public entities where we have employment data, planned capital expenditure, financial ratio, financial summary highlights, management discussion and analysis report, name of the officers and directions. Also, when we report, we should consider accounting policies consistent. Estimates are reasonable. Disclosure is adequate. Terminology is appropriate. Overall structure is fairly presented. So after the audit team makes the last revision to the audit report, final document is given to the management for its review and response. Audit document usually asks the management to respond to each of the audit findings and conclusion by stating whether it agrees or disagrees with the problem cited, the plan to correct any observed problem or deficiencies, and the expected date by which all the issue will have to be addressed. Following this management response, we may formally attach to the final audit report a final exit meeting, which can be scheduled with the company being audited to close any existing loose end or answer questions discussing with the management and their response and address to the scope of audit. Then a finalized audit report is handed over to the necessary stakeholders, including the ones which are outside and inside the area being audited, if applicable. Over to you, Bhakti.
Thank you so much, Komal. Good morning, everyone. As Komal rightly said, that audit is not mandatory in US, but it is highly recommended if it is a good-sized company. Audits may be required for bank loans, VC-funded companies, or companies that plan to exit. This is because the readers of the audit report get a comfort that the financial statements are true and fair. Komal explained the audit process. I will carry it forward to explain what is audit testing, why do we do audit testing, and audit procedures. Once the planning is done, materiality is defined, risk is assessed, and understanding of the entity is obtained, the next step is to perform audit procedures. So what is audit procedures or audit testing? Audit testing is a procedure that allows the auditor to collect sufficient appropriate audit evidence to be able to perform reasonable assurance that the financial statements are free of any material misstatements and are true and fair. Before we discuss about audit testing, it is important to know why is audit testing needed. Audit testing is needed to confirm to certain audit assertions. The auditor uses relevant audit assertions or management assertions to form basis for the assessment of risk of material misstatement and to design and perform the audit procedures. Audit assertions fall into three categories: transaction level, account balance level, and disclosure level assertions. I will focus on the main assertions at all these levels. Existence and occurrence, which means that the transactions or the events have actually occurred and they exist. And very basic example, if employees are working, the salary has to be paid. When the salary is paid, it should not include any employees who are not authorized or who are not part of the employee listing. Another example, when a cost of material is recognized, it is recognized in the period in which it is incurred. The next is completeness, which means that all the transactions and events that should have been recorded are recorded in the period in which they belong and are recorded appropriately. For example, the salary and wages of all the employees are recorded in the period in which it is paid. The next is valuation and allocation. This means that all the assets and the liabilities or the equities exist in the books of the company and are recorded at the correct amount. For example, if any fixed assets have been purchased, we will check that the invoice of the fixed asset is recorded at the correct value in the fixed asset register, correctly represented in the balance sheet. It includes the capitalization costs, if any, and it has been depreciated over the useful life of the asset. The next is right and obligations. This means that all the assets and liabilities are recorded in the books or the balance sheet of the company actually belong to the company. A very good example, all the Chugh buildings. These are all the purchased buildings. These should be recorded in the books of the Chugh company. And this can be verified by the documents or the ownership documents. The next assertion is presentation and disclosures. Presentation and disclosures is actually a combination of all the above assertions, where the transactions have been categorized correctly and disclosures have been made in a manner that is understandable. So Komal already discussed the risk assessment planning, and the various steps of the audit testing is where I'll carry forward. The first step I'll want to discuss is the test of control. Test of control is a procedure to test the effectiveness of the control used by a client or an entity to prevent or detect material misstatements. So a test of control can be made by interviewing the employees at different levels in the organization, or by observing the control procedures, or by inspecting the documents, indicating whether the controls have been applied, or actually retesting the controls ourselves. A classic example of internal controls is segregation of duties. For every function, there is required to have segregation of duties. For example, the invoicing. There has to be different teams for raising a PO, receiving invoices, recording invoices, making payments, and so on. This segregation of duties or existence of controls gives the auditor a comfort that there is less possibility of any fraud or error. The next step to the audit testing comes the substantive analytical procedures, which means that analytical procedures means evaluation of the financial information made by a study of possible relationships amongst the financial and non-financial information. It can be like trend analysis, comparing the previous year data versus the current year data, comparing the budgets versus the actuals. I will briefly want to touch upon the next audit testing tool, which is the test of details. The test of details are procedures such as inspecting a lot of invoices and tracing them back to the various accounts. Listed on the slide are examples of test of details that we can perform to obtain evidence. The test of details is based on sampling techniques. What is sampling? Sampling refers to a small, manageable version of a larger group that can be tested. So sampling testing can be non-statistical, like an auditor judgment, or it can be statistical, like a random number selection. Over to you, Jyoti.
Thank you, Bhakti. This is Jyoti, a team lead at Santa Clara office. I shall be covering the workpaper documentation. So workpaper documentation is one of the key elements of audit. And what I'll be covering is what is audit documentation, why is it important, who is it for, etc. So let's start. What is audit documentation? Audit documentation is nothing but the written record of the audit procedures performed, relevant audit evidence obtained, and the conclusions the auditor reached. It refers to the material that the auditors prepare or obtain and retain in connection with the performance of the audit. So basically, it means all the testing covered by Bhakti earlier, they need to be well documented, which will form our work papers. These in turn will help to form the basis of the auditor's conclusion. Next, we'll move to what are the types of documentation. Okay, over to you, Judith.
Thank you, Jyoti. Hi, everyone. First, let me briefly introduce myself. My name is Judith Terry from Sarita's office. I've been with the Chugh firm for 9 years, happily married, and with 2 lovely kids. I started my audit accounting career back in the Philippines and came here in US on L1 visa. Okay, since we only have a few minutes to discuss this topic, I'm going to keep things brief. So let's get started. My presentation is about quality control and peer review. I want to start with the definition of term. So quality control is a process. In fact, it is an ongoing process through which a company aims to ensure that quality of product or services is maintained or improved. We all know that when it comes to any product or service, quality is an important factor. For example, when you go to a store and buy an item, you look for quality. Or when you go to a restaurant, you as customer expect good, exceptional service. Same thing in accounting and audit practice. When you hire your CPA, you expect him or her to provide quality service. In any organization, especially that market services, quality control is a crucial function because of the involvement of human or the individuality of the service each provides. This factor in the quality control. So it's fair to say that no matter the size of the business is, you need a quality control system or program. In accounting and audit practice, quality control, if you want to comply with the applicable standards or the quality control standards, a firm should have these quality control elements. Okay, these elements in the slides, we have leadership for quality within the firm, shown at the top. You need to have a management that is committed to having an open, honest, ethically correct firm culture, because employees mimic the behavior of top management. The next elements are fairly self-explanatory, so I'm not going to go over each element. Compliance with ethical requirements, client acceptance and continuance, human resources, engagement performance, and lastly, monitoring. The takeaway here is that the overall operations of the accounting audit practice comprise of these elements, from hiring process, quality management, professionals, their skills, their continuing education and their performances, to work paper documentation, deliverables, to monitoring. These elements have to be appropriately designed and should work effectively to say that a firm has good, effective quality control system. Now I'm going to talk about the peer review. Let's go back to the definition of a peer review. Peer review is defined as an independent evaluation of a firm's system of quality control that's required to occur every 3 years. If you notice, I underlined the quality control and the definition of peer review. This is how peer review ties in with quality control. They go hand in hand. Quality control is what a peer review or peer reviewer looks at or examines. Please note that a firm is responsible for its quality control system, and the peer review monitors compliance with that system if it's working effectively or complying with the applicable standards. Now, who performs or does the peer review? In the definition, it says independent evaluation, which I underlined too. That independent evaluation is performed by another CPA or CPA firm, and that CPA or CPA firm has to match the industry or services that the firm being reviewed provide. And that's the reason why peer review is called peer review. Now let's find out why peer review program was created or why there is peer review. Well, as CPAs have so many roles in areas such as tax, audit, accounting, financial services, personal financial planning, etc. CPAs provide different types of services to individuals, banks, creditors, investors, even consumers, even certain government agencies, and so forth. These groups or the general public depend on the accuracy of accounting information when evaluating the financial status of companies and when they're making decisions about what to do with their financial resources. So the integrity of the financial system as a whole depends largely upon the ability of CPAs to perform external audits or other types of services competently. For these groups or the public to extend credibility to the profession, as we already as CPAs has to comply with the CPA's Code of Professional Conduct, which requires that a CPA has to act with integrity, due care, competence, maintain client confidentiality, and most of all, serve the public interest when providing financial services.
Okay, thank you everyone.
Thank you.